Some section of the Nigerian Tax Act 2025, as officially published on June 2025, were nicodemously and unofficially altered after passage. Since then, fragments of the revised text have been circulating in bits and pieces, stripped of context, written in very dense legislative language, and of course, very difficult for the average person to interpret. Much of what has been flying around is couched in statutory jargon, not regular everyday English. So if the altered version felt confusing or deliberately opaque, you're not alone. But in case you haven't been able to grasp the full implementation of these changes, let me bring you up to speed clearly, simply, and without legal gymnastics, with everything you need to know, all for you in a few minutes. So, which is the section affected? The section affected is Section 27 of the Companies Income Tax Provisions in the Nigeria Tax Act of 2025. Specifically, the text that explains how capital allowance, that is tax relief on capital expenditure, is deducted, was altered. Portions of the harmonized bill were added and sections were removed from the gazetted official version. But what happened before adjustment? What is the original harmonized draft? Now, the law simply says you deduct capital allowance based on the amount of qualifying capital expenditure a company incurred. Also, only one certificate was needed from Industrial Inspectorate for a pioneer sector assets. This was straightforward. So once you've spent and gotten certificate, you get tax relief. But what happened after the adjustment? The adjustment law now says that capital allowance is only allowed if the asset is complete, used, and inspected. So, if the asset was partially used or not fully in operation, you can't claim full allowance. It must be prorated. And also, if import duty wasn't paid, you cannot claim allowance. So the law simply removed the simple O allowance rule and replaced it with far more conditions and procedural steps before allowance is allowed. The new language includes phrases like, where assets is not in use, allowance shall not be allowable. And also, qualifying capital expenditure relating to partially used assets shall be prorated. This is a big addition compared to the older draft, but I know I've said lots of jargon as well. Let me explain this in practical terms. You've heard of tax relief. What does it mean? Tax relief is simply any legal way the government allows you to pay less tax. So instead of taxing you on everything you earn, the law allows certain reductions, deductions, or exemptions so you're not overtaxed. And for businesses, it is capital allowance. So, capital allowance is the tax relief companies get when they invest in assets like machines, like power plants, and all that. So, let's work with example to make this very easy. Let's use Dangote because it's been in the news lately. Let's say Dangote decides to buy an equipment, let's say the crude distillation unit, which of course is used in refinery to separate crude oil into petrol, diesel, kerosene, and the other products. So as a Dangote refinery, this single unit alone costs billions of naira. How capital allowance works on this one item is Dangote Refinery buys and installs one of the crude distillation units. The machine is not resellable. It is used for many years to refine crude oil in that company. So because this is a long-term industrial machine, it qualifies for capital allowance under the understanding that this equipment was installed and ready for use. So it is categorized as capital allowance. And because of that, the refinery can start the process to claim tax relief on part of its cost. So when you buy an equipment, you can deduct the cost of that equipment before filing for your tax on your profit. So in simple terms is that you spend billions on this machine. The government is not supposed to tax you because that is not your profit. So under the 2025 interpretation, tax relief on that same crude distillation unit using Dangote crude distillation unit is only allowed after the refinery project is fully completed. The crude distillation unit is fully commissioned. Government inspectors inspect it. A formal certificate is issued. That is the new rule, and that is what has been altered. So, capital allowance is tied strictly to completed and certified projects. The company must get an official certificate from regulators like NIPC, Industrial Inspectorate, and the rest. If the project is not completed or not certified, no tax relief. Partially completed projects are still punished. So if you spend billions but the project isn't finished, the money may not qualify for tax deduction. In some cases, it must be spread over years or disallowed entirely. And so this is another avenue the government has decided to open windows for tax officials because multiple agencies must inspect and approve before tax relief is allowed. In terms of delay or in the act of bureaucracy, no tax relief, even if the money is already spent. And that is the big problem. In simple terms, it means companies can spend huge money building projects. If the government agency delays or decide to frustrate or even refuse certification, the company still pays full tax even though the investment exists. So next time when you see Dangote increase its price, this is where it all came from. Because when capital allowance is delayed, prices don't stay polite, they adjust. You don't grow an economy by taxing machines before they're allowed to work. This isn't about paperwork. It's about whether Nigeria rewards production or punishes it. Because when investment waits for bureaucracy, development waits too. Because when an investor buys an equipment and the government still delays relief, somebody still pays for it. And it's never the government. It is a truth at a time. Take care and have a nice day.